A 40% stock rise. Why is it so difficult? Well, let me show you exactly why. Take this, okay? And let's just take the 40% period from January to January, this period here, okay? It's about 44%. Let's actually look at what that entailed and why so many people, even if they were handed this on a silver platter, would manage to mess it up. Right, first of all, in that journey, let's look at what actually happened, let alone if you actually picked it, but let's assume you did. In that journey, you had a period where you lost 27% in 1, 2, 3, 4, 5 weeks. Over 5 weeks, well, 1 month, 1 week, you're down 27%. Okay? Gets worse. Over the subsequent, let's see now, 3 months, you've got barely any return. So 0% over 3 months on top of that. Gets worse. Remember, you're still getting your 40% across a year. You are then over 3 months down 14%. Back to where you were in February. Okay. And even worse, over the subsequent, let's see, 4 months, you've got another 0% return. So, prolonged periods of 0% returns, periods where, like snakes and ladders, halfway through the year and you're back to where you were near the start of the year in terms of returns, you drop a load of money, 27% in just 1 month. That's your ride to a 40% gain in a year. What does that tell you? Well, first of all, several things. If you think you've got a good company which is undervalued, growing with dividend yields, then don't look at the market every single day, as Warren Buffett doesn't. He says CNBC, Bloomberg, every day you'll look at it, you will go absolutely insane. When I first developed the algorithm on picking stocks based on undervaluation, revenue growth, dividend yields, the rule was 12-month holding period, or if it drops 25% from the entry point, not from the high since I bought it, but the entry point. So in a year like this, I would actually have missed all of that roller coaster ride. I would have slept through it. I wouldn't have looked at it. At the end of the year, I would look back and go, oh, nice, 44% return. Great. Okay. And that was to avoid this psychological behavioral problem. I'd lectured already at Corpus Christi College, Oxford on behavioral finance. I was well aware of the works of people like Richard Thaler and Daniel Kahneman on how to avoid this problem, let alone Warren Buffett, who says the same. So that's point number one. Point number two is, if you look at the historic drawdown and see the depth and the duration, then you can always, when you buy the stock, make a note and say, do not be surprised if after 6 months you have nothing to show for it. Do not be surprised if after 1 month you're down 27%, and set your stop losses accordingly. And if you don't like what you read and write, then don't get the stock. You'll have far fewer companies to choose from, but that's fine. At least they will fit your personality, because otherwise what will happen? That 44%, most people would have missed for a very simple reason. They would have traded their investments. When it fell 10%, 20%, they would have got the hell out of there and never got back in again. When it was going sideways for a prolonged period, they would have got out. When it was going sideways for a second prolonged period, they would have got out. Okay? A whole host of things they would have got wrong. So how do we avoid our students making those mistakes? Well, the answer isn't that we will say to them, hey, don't worry, JP Morgan and everybody else like it. That's not the reason. The way we avoid our students avoiding those problems is, first of all, we make the point I've just made to you, and also show them how to read that information so that they don't panic if they absolutely need to. In an ideal world, I'd say to them, 12 months, or if it drops 25% from the entry, now go away on holiday for 12 months. That's how the rule used to be. The reason we did the 25% from peak rule was because there were years when there were massive gains, like a Crocs, 250% up in 12 months a few years ago. And it went all the way back down to just being up 50. And some of the students said, well, I want to keep some of those gains. So that's why there's an alternative. But beyond that, Again, going back to the words of Warren Buffett, pulling up the plant to see how the roots are doing is not good for the plant. It's not good for your head either. Anyway, that's why most people in their pensions don't get 40% gains, even when the stocks are good. They're their own worst enemies. And that's fine. Don't try and be somebody else. Just try and find stocks which don't exhibit that characteristic as a final filter when you look at companies. Thank you. Oh, have a look at alpeshpatel.com/links. You'll learn a lot there as well. Thanks.